Now that we've had a look at the separate trial balances of the parent and the subsidiary, and we've identified the at acquisition date information as well as the intra-group transaction information, we can start with the consolidation process. If we're happy with the separate TBs of the parent and subsidiary as my starting point, and we agree that they have the same reporting dates and they applied the same accounting policies, we do not have any adjustments in respect of that. We can use it as it is as my starting point. Combining the balances and totals of P and S as my starting point, giving effect to the 100% P plus 100% S principle will happen on the individual line items in the consolidated financial statements. The first category of consolidation journal entries is the business combination valuation journals. You will only have consolidation journals under this heading if the identifiable assets and liabilities of the subsidiary are not fairly valued at acquisition date. And we'll have examples of that when we get to Chapter 7. But the additional information mentioned that the identifiable assets and liabilities of the subsidiary are fairly valued at acquisition date, and that's why we have no consolidation journal entries under this category. So the first consolidation journal entry we will look at is the at acquisition consolidation journal entry, where we eliminate the at acquisition equity of the subsidiary against the investment made by the parent as the common items. All of these amounts were given. The 142,500 Rand is in the trial balance as share capital of S, and the additional information mentioned that the share capital didn't change since acquisition date, and that's why we can use it as the at acquisition share capital. The investment in the subsidiary in the TB of P is measured at 118,600 Rand, and I have mentioned that the policy is to measure this investment at cost. So we can therefore take that trial balance amount as the cost of this investment as the consideration paid by P. Then the additional information mentioned that NCI is measured at their fair value of 50,000 Rand. As a result, this business combination has goodwill, and it's an amount that you can calculate. It's not merely a balancing entry. What the parent was willing to pay for his proportionate share, together with what the parent measured NCI to be, compared to the at acquisition date value of the business of the subsidiary, was more. Therefore, the parent is of opinion that there's future economic benefits from this business combination, and therefore we have goodwill. All consolidation journal entries have a specific objective or purpose. We write them because we want to achieve something when we prepare the consolidated financial statements. The next category of consolidation journal entries is my intra-group journals. The purpose of all of these journal entries are to eliminate my intra-group transactions between the parent and the subsidiary. Journal 2 and 3 looks at the intra-group dividend, which is the dividend declared and paid by the subsidiary. The amounts of 15,000 and 10,000 you can find on the trial balances. Please refer back to the discussion of this consolidation journal entry. We eliminate the full dividend declared by the subsidiary, so that in the statement of changes in equity of the group, we are left only with the dividend declared by the parent. The parent's portion of this dividend is included in other income of the parent, so it eliminates out of dividend income at the parent's proportionate share. This will affect your other income line item in profit and loss. The portion of the dividend declared and paid to the non-controlling interest makes their balance smaller. They got something back of what they are entitled to. They share in a negative movement in the equity of the subsidiary represented by the dividend. So that's why we debit their balance with their proportionate share of this dividend. Journal 4 eliminates the rental income and rental expense. We've already calculated the amount of 36,000 Rand. We debit the income, we credit the expense. It's an adjusting journal entry. We eliminate these amounts, and you'll again see the effect in the profit and loss line items. Journal 5 eliminates finance income and finance cost. We've already calculated the 2,500 Rand. We debit the income, we credit the expense. You'll see the effect in the profit and loss line items, and it's again an adjusting journal entry that eliminates these amounts. Journal 6 eliminates the intra-group loan balances. We will have this journal as long as the balance is still outstanding. We debit the liability, loan from P Limited, coming from the separate financial statements of S. We credit the asset, loan to S Limited, coming from the separate TB of P. Please, when you write this journal entry, indicate whether it's the debit or the debt, the asset or the liability. You have to indicate that it's the loan from P that you debit and the loan to S that you credit. Journal 7 eliminates the intragroup admin fee. The 12,000 Rand is for the entire year because it's a monthly expense. Debit the income, credit the expense, and this will again eliminate in your profit and loss. The next category of consolidation journal entries relate to the since acquisition consolidation journal entries, and specifically where we measure the NCI balance in the consolidated financial statements. Journal 8 attributes a portion of the since acquisition date movement in the retained earnings of the subsidiary to the NCI opening balance. In the analysis of equity or in the timeline, we identify the since to opening balance movements in the equity of the subsidiary. Why are we working with movements? We have a trial balance, opening balance for the equity items of the subsidiary. We've eliminated the at acquisition amounts that's included in those trial balance amounts. We are left with the movement in the equity that's allowed to be in the group, and that equity of S that's allowed to be in the group needs to be attributed to the equity participants. By attributing a portion of that movement to NCI, you are left with the amount in that balance attributable to the owners of the parent. Now, share capital is also an equity item of the subsidiary, but share capital gets eliminated at acquisition date, and we specifically mentioned that they didn't show any movement since acquisition date. So if you start with the TB share capital and you eliminate the at acquisition amount, there's no movement left to attribute to the equity participants. But for retained earnings, we did have a movement. We always start with the TB opening retained earnings balance. That's what you have. That's your starting point. But you have to realize that 127,500 Rand includes the at acquisition amount of 7,500, which gets eliminated. So you have to deduct that 7,500 to be left with the movement in the retained earnings since acquisition date that's allowed to be in the group. And this is not a recipe that we study. Why do we deduct the 7,500? Please refer back to your at acquisition consolidation journal entry. There was a debit to retained earnings of S for 7,500 Rand. So the effect of that at acquisition consolidation journal entry is to first of all reduce the retained earnings opening balance of S with the 7,500 before you attribute to NCI. This journal 8 is where you now attribute the movement to NCI. So what happens in this journal is because you're debiting the retained earnings opening balance of the subsidiary, you're making that balance less. You are taking a portion from that balance and moving it out to your non-controlling interest opening balance. This calculation of the 36,000 Rand also happens either on your timeline or in your analysis of equity in the since to opening balance period. Journal 9 attributes profit of the subsidiary to my non-controlling interest. So my debit entry is profit attributable to NCI, and I credit my current year movement of non-controlling interests, and I end up increasing their balance again. When calculating profit attributable to NCI, your starting point is always the profit of the subsidiary only. You cannot take the total profit of the group as it includes the profit of the parent. NCI is only an equity participant in the subsidiary, so your starting point for this calculation will always be the subsidiary's separate profit. But because we had intra-group consolidation journal entries in this example, we have to go through each of those journal entries and decide whether we have to adjust this profit of the subsidiary as my starting point for the effect of those consolidation journal entries before I attribute to NCI. So let's do that. Journal 2 and 3 of the intra-group journals was for the dividend elimination. Does Journal 2 and 3 change the profit of the group? Because that's the first question you have to ask. And the answer is yes. The debit entry to dividend income for 17,500 eliminates other income from the combined totals of P and S. The credit leg, dividend declared, changes the statement of changes in equity, and the debit to NCI also has an effect in the statement of changes in equity. So Journal 2 and 3 has a debit effect to profit and loss. So Journal 2 and 3 does change the profit of the group. But whose profit am I changing in the process? From which entity's starting point am I eliminating this other income? And it's from the parent. So therefore, when calculating profit attributable to NCI, you will not include the effect of this journal before attributing. Journal 4 and 5 is for the rental income and finance income consolidation journal entries. Do these journals change the profit of the group? No, they don't. It's a debit and credit to profit and loss for the same amount. So therefore, you will not consider the effect of Journal 4 and 5 before attributing profit to NCI. Let's talk about Journal 6. Would Journal 6 have an effect on the profit of the group? No, because it is adjusting a liability and an asset balance. And what about Journal 7? Will Journal 7 have an effect on the profit of the group? Also not, because it's again adjusting a profit and loss item, income and expense with 12,000 Rand. So back to Journal 9, where we attribute profit to NCI. That starting point, being the profit of the subsidiary, will not be adjusted for the effect of any of the consolidation journal entries before we attribute to NCI.